You can legally pay $0 in federal taxes on $130,000 of income. The problem is your advisor doesn't show you this, and your CPA, they don't plan ahead. I use this strategy with retired clients every single year. I'm Ryan Knoll, a certified financial planner and founder of NavWealth Partners, and this is one of the most overlooked tax strategies in retirement. Here's exactly how it works, the entire strategy. Fill up your standard or itemized deduction with ordinary income. Then take capital gains up to the 0% bracket. That's how you get to $0 in federal taxes. It's simple in theory, but where most people mess this up is how their income actually stacks together. IRA withdrawals, those are taxed as ordinary income. Capital gains, that's a different bracket altogether. And your dividends, well, that depends. And this is where most retirees get lost because one wrong move pushes you into a taxable bracket. So before we look at an example, you need to understand how each income source flows and how it can break the strategy. Most people think all income in retirement is taxed the same. It's not. And this is exactly where people mess this up. There's one bucket that matters more than anything else, and it's your ordinary income bucket. So what counts as ordinary income? First is IRA withdrawals. Every dollar you pull from a traditional IRA or 401k is taxed as ordinary income. Second is your pension income. If you have one, that's fully taxable as ordinary income as well. Third is your Social Security, and depending on your provisional income, up to 85% of your benefit can get pulled into this same bucket. Next is interest income, which is from savings accounts, CDs, and bonds. This all counts as ordinary income. And last is the trickiest source, that's non-qualified dividends. Many people don't realize dividends paid from positions that don't meet the holding period requirement are taxed at ordinary rates, giving you less room to work with. And once you use your standard or itemized deduction, you start creeping into taxable territory, which means if you don't control these income sources carefully, you can completely ruin the $0 tax strategy before it even starts. Once you understand this, then you can start layering in the second piece, which is capital gains. Here's what you need to know about the capital gains bucket. In 2026, if your taxable income is below $98,900 for married couples and half of that for singles, all capital gains are completely tax-free. Taxable income is your ordinary income plus capital gains income less your standard or itemized deduction. Because you already offset your ordinary income by your standard deduction, you have nearly $99,000 of room before you pay taxes, assuming you're married. So what goes into capital gains? First is selling investments in a brokerage account. If you sell stocks, ETFs, or mutual funds for a profit, that gain is a capital gain. Second is qualified dividends, or these are the dividends that meet specific holding period requirements, and they're taxed at capital gains rates, not ordinary income rates. And this is where the opportunity is, because once your ordinary income fills up your standard deduction, you can stack capital gains on top and still stay in the 0% bracket. But here's where people mess this up. They don't realize that capital gains still stack on top of ordinary income. So if your ordinary income is too high, you push those gains out of the 0% range, and now you owe taxes. That's the same assets and the same gains, but a completely different outcome just based on how you structured your income. That's why this piece matters, because once you control your ordinary income, you unlock the ability to take gains completely tax-free. Here's where this strategy can break down. Two things derail it more often than not: timing issues and large one-time events. The first timing issue is taking Social Security too early. Social Security fills up ordinary income, leaving you less room to work with. Most clients end up delaying their benefits, assuming they have the means, and ultimately receive a larger benefit when they do collect, leaving this strategy intact. The second is not planning their income to last all year. This causes more withdrawals, higher capital gains, and increased likelihood of taxes, all because they did not sequence income correctly. When it comes to one-time events, I normally see two derail this plan. The big one is selling a home. Yes, there's an exclusion, but if your gains go beyond it, you just created a large taxable event. This can be common with retirees who've often lived in their home for a long time, often decades. They make a larger profit and increase their risk. The other is selling a business. Depending on how the deal is structured, you can trigger both ordinary income and capital gains in the same year. Interest from seller financing is ordinary income, which eats into your deduction, and the sale itself creates capital gains using up your 0% bracket. Let's look at what this actually looks like in the real world. Say a married couple, both spouses over 65, earns $130,000 in 2026 while they're still working. That is their AGI after all 401k contributions and employer benefits are paid for. They would owe roughly $9,400 in federal taxes. And because they are working, they would owe an additional $10,000 in FICA taxes. That's nearly $20,000 gone and an effective tax rate of nearly 15%, which leaves them with $110,000 after tax. But let's say they actually need $150,000 to live on. Now they have a $40,000 gap. That could come from Social Security or their portfolio. Let's assume they just pull it from their brokerage account, and the $40,000 that they need to spend has them incur $20,000 worth of gains. This would increase their taxes by another $900 for the year. Not a huge number, but that's still money lost to the IRS. Now let's look at how this same couple can reduce their tax bill on the exact same $150,000 of income down to $0. First, because they're 65, their total standard deduction for the year is $35,500. They pull that amount from their traditional retirement accounts. This uses the full deduction and they pay no tax on it. That covers their first portion of the income stack. Now they still need $115,000 to reach their $150,000 goal. So they pull it from their brokerage account. This creates $60,000 in capital gains. That $60,000 adds to their taxable income, which is still below the $98,900 threshold. Therefore, they would pay no income tax to make all of this happen. Now, if you actually want to apply this, you need to know exactly how much taxable income you're generating each year. So we built a simple tool to help with that. It's our Roth Conversion guide, and it shows you how your income stacks based on your age, filing status, and deductions. So you can stay under these thresholds and avoid paying unnecessary taxes. You can grab it for free below. Now there's one more advantage to this strategy that only exists through 2028. Starting in 2025, the tax code changed for anyone over 65. You're eligible for an additional $6,000 per person annually on top of your standard or itemized deduction. For a married couple, that is an extra $12,000 tax-free. As long as your modified adjusted gross income is below $75,000 for single filers and $150,000 for married filers, you qualify. In our example, the couple has an additional $12,000 to offset with their IRA withdrawals without paying taxes. So instead of stopping at $35,500, they could increase their withdrawals to $47,500 and still stay within their tax-free window. This is a limited time opportunity and most people won't take advantage of it. So now you know how to generate $130,000 of income and still pay $0 in taxes. But this is where most people stop. And that's a big mistake because you should not be thinking about just this year. You should be thinking about your lifetime tax bill. Let's go back to our couple. They withdraw $47,500 from their IRAs and fill up their deduction and over $100,000 from their brokerage account, creating $55,000 in gains, still $0 in taxes. What happens next is what most people miss. The 0% gains limit is $98,900. Which means they can realize another $44,000 in gains completely tax-free. So why would they do that? Because realizing gains now resets their cost basis, which means fewer taxable gains in the future. And that matters because once Social Security and RMDs kick in, their brackets are likely higher. So instead of paying more taxes later, they take advantage of this window now, realizing gains tax-free, reducing future tax exposure, and lowering their lifetime tax bill. So the takeaway is simple. This isn't about avoiding taxes for 1 year. It's about understanding how the system works and using it to minimize what you pay over your lifetime. Because the difference between doing this right and doing it wrong can easily be tens or even hundreds of thousands of dollars. And most people never realize it until it's too late. If you want help structuring this the right way, that's exactly what we do. You can start with the free Roth Conversion guide below or reach out to us directly if you want a plan built around your situation. The links are in the description. I'll see you in the next video.